Before we talk about how to survive a market crash, let's first define what a crash really is. A stock market crash is typically a sudden, sharp decline in the value of stocks, often 10% or more in a short period like a few days or weeks. Unlike a correction, which is a more gradual pullback, a crash is rapid, and it can feel like a gut punch to investors. It's important to remember that crashes are a normal part of market cycles. In fact, they've happened throughout history, and while painful, they're often followed by recovery. Famous examples include the 1929 Great Depression, the 2008 financial crisis, and more recent corrections like the 2020 COVID crash. Understanding that these events are part of the market's natural ebb and flow can help reduce some of the fear and panic when things start to go south. Chapter 2. Why do market crashes happen? So, why do market crashes happen in the first place? There are a number of factors at play, and often it's a combination of different events that cause panic and mass sell-offs. Let's break it down. Economic instability. A downturn in the economy, like high inflation, rising unemployment, or a recession, can trigger a market crash. When economic indicators are bad, investors start selling off stocks to protect their portfolios. Excessive speculation. During times of extreme optimism, stocks can become overvalued. People get caught up in speculative bubbles, and when those bubbles burst, the market crashes. Geopolitical events. War, political instability, or global crises, like a pandemic, can spook investors. These events disrupt supply chains, cause uncertainty, and ultimately affect the markets. Liquidity issues. Sometimes a lack of liquidity, when there aren't enough buyers and sellers in the market, can cause sharp declines. This is often seen during a financial crisis when banks or corporations are in trouble. While we can't predict exactly when a crash will happen, knowing these triggers can help us be more prepared. Chapter 3. How to react when the market crashes. It's easy to panic during a market crash, but it's crucial to stay calm and stick to your long-term strategy. Here are some key tips for managing your emotions and actions when the market is in turmoil. Don't sell in panic. The most important thing you can do during a crash is resist the urge to sell everything. If you sell your investments out of fear, you'll likely lock in your losses. Instead, focus on your long-term financial goals. Remember, stocks have historically recovered from crashes, even though it can take time. Reevaluate your portfolio. A market crash is a good time to take a step back and reassess your investment strategy. Do you have too much exposure to risky assets? Is your portfolio diversified enough to weather downturns? It may be a good idea to rebalance, but don't make impulsive moves out of fear. Focus on quality stocks. Not all stocks are created equal, and during a crash, it's important to stick with high-quality investments, companies with strong fundamentals, solid earnings, and a good track record. These are the ones likely to recover the quickest. Take advantage of opportunities. A crash might offer some of the best buying opportunities for long-term investors. Stocks that were once overvalued may now be priced attractively. If you have cash on hand and your risk tolerance allows it, this might be the perfect time to buy. Stay informed but avoid overloading on news. The news during a crash can be overwhelming, but it's important not to get caught in the panic. Stay informed but don't let headlines drive your decisions. Focus on facts, not fear. Chapter 4. Building a resilient portfolio before a crash. The best time to prepare for a stock market crash is long before it happens. Here's how you can build a portfolio that will help you survive, and potentially even profit, from the next downturn. Diversify across asset classes. Don't put all your eggs in one basket. Spread your investments across different asset classes. Stocks, bonds, real estate, and commodities. This way, if one sector crashes, you have others that can help cushion the blow. Have an emergency fund. A cash reserve for emergencies is essential. It can help you avoid having to sell investments in a panic if you need cash quickly. Aim for 3 to 6 months' worth of living expenses in a high-yield savings account or money market fund. Focus on long-term growth. Rather than trying to time the market, focus on long-term growth. Invest in companies with solid fundamentals that are likely to perform well in the long run, even during downturns. Dollar cost averaging. This strategy involves consistently investing a fixed amount of money at regular intervals, regardless of market conditions. By doing so, you avoid the temptation to time the market and help smooth out the effects of market volatility over time. Consider defensive stocks. Defensive stocks, such as utilities, healthcare, and consumer staples, tend to perform better during economic downturns because people need these services regardless of the economic climate. Adding these to your portfolio can help reduce risk during a crash. Chapter 5. Mental strategies for staying calm. When the market is crashing, it can be tough to keep a clear head. But maintaining your mental clarity is key to making smart decisions. Here are a few strategies to help you stay calm and rational. Practice emotional detachment. Don't let the daily ups and downs of the market affect your emotions. If you're feeling overwhelmed, take a break from checking your portfolio. Remember, investing is a marathon, not a sprint. Stick to your plan. If you've done the work to create a solid investment plan, now is not the time to abandon it. Trust in your strategy and stick with it. If you haven't already, now might be the time to develop one. Focus on what you can control. The stock market is unpredictable, but you can control how you react. Focus on things that are within your power, such as maintaining your savings rate, diversifying your investments, and educating yourself about the market. Remember history. Keep in mind that markets have always recovered from crashes. While the timing of a recovery is uncertain, history shows that over the long term, markets tend to bounce back. Knowing this can help you stay optimistic during a downturn. Chapter 6. When to seek professional advice. Sometimes, the best way to navigate a market crash is to seek the help of a financial professional. If you're feeling uncertain about your investments, or if you simply need some guidance, a certified financial planner or advisor can help you reassess your strategy and make informed decisions. They can help you understand your risk tolerance, create a plan for managing your portfolio during a crash, and guide you toward making the best decisions for your financial future. To wrap up, surviving a stock market crash is all about preparation, patience, and perspective. Stay calm, stick to your long-term plan, and remember that crashes are temporary. If you build a diversified portfolio, stay informed, and focus on your financial goals, you'll come out of it stronger and more resilient than ever. Thanks for listening to the ultimate guide to surviving a stock market crash. If you found this helpful, don't forget to like, share, and subscribe for more tips on managing your investments and building wealth. Stay calm, stay patient, and keep investing.